I think silver still is going to $300 to $500, 300 to 500. And I know people will laugh at that. In fact, we were arguing back 2 years ago that we were going to probably run up to $90 plus at some point this past year. And we got laughed at for that. But I actually think there's a variety of various reasons to justify silver going to that kind of price level. And we've explained that to our subscribers in layers of the arguments. Some of them are technical, price technical. Most of them are minimum based, but some of them are just monetary valuation based. Like, take for example, if silver hit 50 in 1980, where was the money supply then? M2. You get an M2 chart from the Fed. You can punch one up, go back and see where it was and see how much it's grown since. It's incredible. It's parabolic. Or you go back to 2011. That's when silver again went up to the top of that that capped off range at 50. It got bagged again. So you had two times you went to 50, but the money growth just continues and continues. And if you look at other markets, like gold, the mama market of the monetary metals, silver's the little baby, but it's still a monetary metal. It's been one for 3,000 years, just like gold has. But gold hasn't been stopped by prior highs. Its 1980 peak was not confinement for gold in 2011. It blew the heck, it doubled it, or now it keeps making higher highs, yet silver was capped. Highly unusual. It fits with, the argument made by many that, some bodies have been trying to keep this market suppressed. Or you can look at a copper chart and you go back to 1970s, 1980s, 90s, 2000, through about late 2005, copper was in a little Deadsville range of 50 cents to $1.50 a pound, 50 cents to $1.50 for decades. Just like, boring. In late 2005, it finally punched through the top of that price range. Okay. And it did it on its own. It didn't do it because gold was exploding and silver was, everything was exploding. It did it on its own. And it quadrupled in price in a matter of a couple quarters, and then lived in a new reality between $3.50 and $4, $4.50. Instead of 50 cents to $1.50. But the move from one to the other wasn't gradual, let's be cautious type rally. It was explosive. And
for decades, silver has been caged, held down, artificially confined to a ceiling that gold shattered long ago, while copper broke free and quadrupled almost overnight. But what happens when a market that has been suppressed for 50 years finally breaks loose? History tells us it doesn't creep higher, it detonates. And right now, the technical signals, the monetary math, and the spread charts are all pointing to the same terrifying conclusion. Silver is about to reprice reality in a matter of months, not years. The money supply has gone parabolic. The value of your dollar has been quietly gutted for generations, and most people won't see it coming until it's already happened. To break down exactly what's unfolding and where silver could be headed before this summer is over, here is market structure analyst and momentum strategist Michael Oliver.
If you didn't catch it, you didn't catch it. And of course, now copper's even making a higher high, $6. But why was silver contained? Gold wasn't, copper wasn't, lead wasn't. But silver was contained. Well, so one of the arguments is that if you've been in markets long enough, stock markets, whatever, you've seen instances where a market gets overpriced. It goes too far for too long. Yeah, its arguments were good and solid, but it did it excessively, like the .com top, let's say. And when it corrected for that, it didn't correct in a mild way. It did it in a savage way. It probably even excessively the other way to correct its prior error. So like the .com, NASDAQ 100 back then, which was representative of the .com stocks and stuff in 2000, when it made its low in 2002, it had dropped 80+%. Does that mean that all the fundamental arguments favoring how the internet would change our lives was wrong? No. It just overdid itself on the upside and it overdid itself on the downside. Markets do that. And while silver's been a contained beast, we argue, on technical reasons, but also for the argument I just presented, that for monetary reasons and its confinement, that it's going to correct for that. And it's not going to do it in some, incremental way. It'll do it very rapidly. And it'll go to a pricing level that makes some sense, or probably even beyond one that makes sense, in the overshoot. So that's what we're looking at. And there are plenty of examples of markets that have done this throughout history. So it's not like a one-time event. For silver, it will be, but for other markets, we've seen it. And I think that's what's happening right now. And I think you're largely going to see the move done by this time, sometime this summer. Meaning,
does that imply an end to the bull market by the summer then?
Well, no, in a way, but it means a repricing of silver's reality. In other words, it may end its move at some point, but it's not going to go back to $50 again. In other words, it might go from 500 to 300 in a correction or something, but you're going to be in a new reality. And the point is to catch that move to the new reality. I also think when that occurs, of course, gold will be advancing as well, just not as much. And silver is already technically broken out versus gold. As we run spread charts, what we do is we divide an ounce of silver into an ounce of gold and express it as a percent. And if you look back, for example, 1980, when we were $50 silver, at that point in time, silver was 6.5% of an ounce of gold. Okay.
Think about what it actually means when silver was $50 in 1980 and again in 2011, and yet today it still sits at a fraction of gold's value, even as the money supply has grown exponentially since then. That's not a market in equilibrium. That is a coiled spring, and when silver broke out of a 10-year ceiling in its performance against gold back in November, it didn't whisper, it announced. Markets that overcorrect on the downside have always corrected for that error. And when they do, they don't drift, they explode. A new pricing reality for silver isn't a theory anymore. It is a pattern playing out in real time.
In 2011, when once again it went back to 50, still in that price range, it was 3.1% of the price of gold. Where's silver right now? 1.6%. So if silver price blew out the 50-year range and more than doubled that range at one point, got to 120, why won't its spread maybe also catch up to gold and go to, let's say just one of those two highs, the 3.1% high that occurred in 1980 when silver was still confined in its price range and only half its relative value what it was in 1980 to gold. Let's say silver goes to 3%. You do the math on that. I mean, silver could double its relative value to gold between now and then, and it's likely to do it quickly. When we plot that spread chart month to month, back in November of last year, silver blew out a 10-year wide ceiling of those readings and said, I'm out of here. I'm coming out of this base. I'm going to outperform gold. And even with the drops that we saw in the last couple of months, mostly occurring in that last day of January, actually, the spread has not broken down much at all. In other words, silver has not collapsed relative to gold when you plot that chart. So the breakout is valid. It's fresh. It only happened in November. It took out a 10-year wide base. So you treat it like a price chart. Here you have this price chart of a range going back 10 years on the relative performance of silver to gold. And it broke out of a very clear, if you see the spread chart, which we showed our subscribers, it's jaw-dropping. You say, wow, I got to own that. Well, what it means is I got to own silver over gold. And so I think during this process that we're in now, when we re-engage gold and silver now, silver's the one that's going to just white knuckle flight.
If it does kind of top out, and top out in the sense that it will kind of reach this new reality, this new reality, does that also imply that it becomes kind of an analog to the last bull market where we kind of saw a top out in 2011 and then we just moved sideways for about a decade? Or
well, it could be, but I think there's something else going on here. And it's far bigger than it's the monetary metals reason for going up. It's not because of this, that, or other news story that people like to always attach to gold. And they get smacked in the face when they do. Like, for instance, recently, if you thought, oh, war in Iran, that's bullish for gold because it's global uncertainty. That's not what drives gold. What drives gold ultimately is the ongoing decay and ultimately collapse in the real value of fiat monies. Not just ours, but the yen, the euro, all of them, in constant decay in real value. But so when you look at an M2 chart, and it basically every decade it gains 80% from where it was the decade before. That's why when you were your granddad built a house, the average cost was $4,500. Your dad built one, it was $45,000. Now the mean price of a home is $450,000. It's reflecting what? The ongoing decay in the money unit.